What's up, everybody? We are going to talk about 3 deep value stocks today. 2, we're just going to touch on very briefly. And then the last one, the third one, I bought a little bit more of just recently. So we'll talk about that stock. I'll tell you why I'm adding to my position. As always, if you get value out of the video, subscribe to the channel. Nothing here is advice to buy or sell any of these stocks. I'm just giving you my opinion and telling you what I'm doing with my money. Now, let's get into it. And before we start, let's just talk about the market because it is getting harder and harder to find deep value stocks. The market is at all-time highs, and it feels pretty good to log into my brokerage and see a nice big number. I'm at an all-time high too, as I'm sure many of you are as well. But it does make it harder to find opportunities to deploy our capital. There aren't as many of them now as there were a few months ago. Now, my holdings look very different from the S&P 500. I talk about pretty much all my major holdings here on the channel. I do own 2 mega cap stocks, Google and Amazon, and while I don't plan on selling them, I think that they're great companies. Currently, I think they're just trading for fair valuations. I thought they looked pretty cheap not too long ago, but it is getting hard to find cheap nowadays. Even the health insurance companies, which I've talked about on this channel a bunch, have rallied quite a bit over the past month. UNH up 35%, and the first value company we're going to talk about today is Centene. I made a video on Centene a month and a half ago. I said I thought it looked ridiculously cheap. I own a position here. A couple of viewers have asked for an update on Centene or another Centene video, and yesterday the stock was up a ton, almost 10%. But the truth is, this is going to be a very short update because essentially nothing has changed about my thesis on this company. My thoughts are really similar to what they were a month and a half ago. When I made this video, the stock was trading for under $27 a share. In my base case, I was looking at close to a triple on the stock. As far as the news that came out on this company, the reason why it was up basically 10% yesterday is they just reaffirmed their guidance for the year at, $1.75 a share. That's honestly not really news. I mean, they gave that guidance a month ago, and all they said yesterday is, yeah, we still have the same guidance for the year. As a quick refresher, Centene is a health insurance company that is very much involved in Medicaid and also the marketplace. And they've really been slammed on both this year. Costs have been coming in much higher than they thought. They're not going to be able to reprice most of their book until January 1st of 2026. So, we're not going to see better earnings from this company, I think, until Q1 of next year at the earliest. But just to give you a sense of the upside, if this company recovers, if they continue growing, 9-ish% on the top line, revenue is going to go up for all these companies. There might be a dip next year as marketplace subsidies expire, but the demand for healthcare is just going to go up and to the right. All the large health insurance players in the US are going to see their revenue increase over time. The only real question is going to be margins. Is Centene going to be able to recover to, 2-ish% margins, or are they going to be, like they are this year, a 1% operating margin company? I know these numbers sound ridiculously small, but that's the game that they're playing. They're in Medicaid. Medicaid is, the thinnest margin segment of healthcare. Healthcare is already a razor thin operating margin segment. You're talking single-digit margins across the board. Even the leaders like UNH and Elevance, they have single-digit operating margins. But if Centene recovers to, 2.5% operating margins, which is my bull scenario, and their free cash flow margin, I'll give them about 1% there, give them about 15 times operating income for a multiple, which I think is a bullish scenario for this company, then you're looking at 50% annualized on this stock every year for 5 years. My base case a month and a half ago, which I still think are reasonable numbers that I believe the company is more likely to beat than not, were 5% growth on the top line, just recovering to 1.5% operating margins, which would not be a full recovery. This is not where the company has been for the vast majority of its history. I'm giving them just 0.5% free cash flow and 10 times operating income. And if this scenario comes true, you're looking at 18% annualized return on Centene stock today. In other words, 5 years from now, you're looking at more than a double on your money. I think the stock is cheap. I think it remains cheap even after its increase. If you're interested, the numbers I had for my bear scenario a month and a half ago were no revenue growth at all for 5 years. This is if you have a significant loss in membership from the removal of subsidies. And if margins compress even more, just 1% operating margin, no free cash flow for the next couple years, and I'm only going to give them a 7 times multiple. And yes, in this scenario, you would be down on your money after 5 years. This is the doomsday health insurance never recovers scenario. I think this is very unlikely, but yeah, that's my bear case. It has to be said, I think Centene has higher risk than UNH and Elevance. It is very focused on Medicaid and the marketplace. I mean, for example, in 2024, Centene's adjusted EPS was over $7 a share. This year, it's going to be $1 and change. $1.75, again, is what they're guiding for. That is a massive fall. That's what I mean when I say Centene is riskier. They don't have, for example, a health services side of their company in the way that UNH does to pad a little bit of these down years. I'll link my previous Centene video in the description, but basically that's my update. My update is there is no update. The price is just higher. I have the same views I had on the company that I had before. It's just a little more expensive, so the risk reward isn't quite as good as it was, but obviously I'm not selling. I'm happy to hold my Centene shares. Now, what I wanted to talk about today is the company that I bought a little bit more of, but the reason I had capital in my account to buy this company is I got paid a couple dividends recently, the largest of which was from GSL. GSL is definitely a deep value stock. I have talked about it on this channel before. It's a shipping company, and if that means it is an absolute no for you, I totally understand. Shipping is an extremely volatile sector. I don't think there is such a thing as a shipping company with consistent earnings, and many shipping companies have poor corporate governance. However, that's not the case with GSL. GSL, I trust the management. I think they have an excellent management team. This company owns small and mid-sized container ships, and they lease them out on long-term charters, so they have a lot of forward visibility of their cash flow. I've owned this stock for a decent amount of time, a couple years now. I was buying in this range over here back in 2023. And at the time, the company was trading for, a little over 2 times earnings, and they have a bunch of forward contracts. They were saying, we have like 1.5 to 2 billion in contracted revenue. That's about 2 years of an average contract cover that we have coming up. These are with major transport companies like Maersk, Hapag-Lloyd. These are the companies that are leasing their ships. And once their contracts expire in a few years, I have no clue what's going to happen to the container market. Rates might be way lower than they are today. But when I was buying the stock, I had forward visibility for about a couple years of earnings, and they were trading for only a couple times earnings. So to me, it was not a hard buy. Now, the stock has gone up quite a bit. It's trading for 3 times earnings. Charter rates are still high. They're going to make over $10 in earnings per share for the year. I'm in a similar situation to a couple years ago. I have no clue where charter rates are going to be for container ships in a few years. When these charters are up, when their contracts expire, I have no clue the rates that they will be able to renew their contracts for. They may be significantly lower than the rates are today. I think the risk reward is still quite reasonable with GSL. Operationally, the company is less risky now than when I bought the stock. They've paid down a decent amount of their debt. They've lowered their financial leverage. Their credit rating has improved. So I'm happy to keep holding this company. You're also still getting paid to just wait here. You're getting paid a decent dividend, 6.5%. Relative to my cost basis, what I've actually paid for my shares, I'm actually getting over a 10% dividend today on GSL. I could just reinvest this dividend right back into them, right back into GSL, but this is now a significant holding in my portfolio, and I'm not really looking to add to the weight here. So this brings me to the third company of our video, and this is the one that I actually bought a little bit more of, and that is Adecoagro, ticker symbol AGRO. I made a video on this company a couple months ago when I bought a starter position, about 1% of my portfolio. I'll give you the quick overview here, just a refresher on what this company does, why I like them. They are a relatively large producer of a bunch of agricultural products. So we see sugar, ethanol, energy, that is their main segment, but also dairy, rice, crops. Crops includes corn, peanuts, wheat, stuff like that. Now, commodities, the prices of commodities are extremely volatile. Just to look at sugar, because that is the most important product for them. I mean, if we look at a chart of rice or peanuts or whatever, they would look similar. Sugar prices today roughly cut in half from where they were a couple years ago. If we look over the past 10 years, sugar prices are all over the place. For a company like Adecoagro, this is a direct hit to their bottom line. Also, this past season, weather has not been on their side. It has been unusually hot and unusually dry in South America where they are operating. I think that the recent weakness in earnings is not structural. It's not a problem with the company. It is a problem with circumstances, commodity prices, and weather that I think are mostly out of their control. Operationally, this has been a very well-run business. They have been increasing their total farming area. Their production has gone up. Revenue is doing well. They are very low-cost producers, which means even when you have really tough pricing environments, they're still doing okay. Yes, their earnings are not going to look great this year, but for many commodity producers, when the price of the commodity that you are producing goes down, earnings can be massively negative. That's not going to be the case here. And the lower prices we're seeing right now for a lot of agricultural commodities, rice, sugar, in the long run, the price of these goods in dollars is going to go up. I don't know if the price of rice a year from now will be higher than it is today, but I would certainly put money on it that the price of rice 10 years from now would be higher than it is today. Rice prices are down more than 30% in a little over a year. With commodities, it's very common to get periods of oversupply, and then producers pull back, and then prices rise, and then producers come back in. It's a cyclical industry. With the part of the cycle we're in, yeah, Adecoagro looks like earnings are going down and they're not doing well. But when I look at the operations of the business, I see a well-run company that is improving its production, has excellent cost control, owns a ton of land, and yeah, right now commodity prices are down, and they also had a really tough year for weather. When I bought this company, it was a little over $9 a share. I thought it was good risk reward. The stock right now is a little over $8 a share. In fact, if you bought on Tuesday, you could have bought for under $8. I bought my position on Wednesday just for a little over $8 a share. It's not a big deal to me. I think the stock still offers great risk reward. Just going to update our sheet here. Margins are going to be very volatile for a company like this. But I think in the long run, through the cycle, I think we're offered an opportunity today with this stock. Going through my assumptions here, in my base case, I'm just assuming 6% revenue growth. That's basically inflation plus a little bit of increase in production and operating margins of 15%. We've seen, margins in the 20s, margins in the single digits in very bad years. I think throughout the cycle, a 15% operating margin is actually pretty conservative. And I brought their free cash flow margin back for the next couple years and then increasing it in 2027. And I'm only giving them a 9 times multiple on operating income. With these assumptions, you're looking at a 24% annualized return on the stock today. That's roughly a triple over 5 years. I think my assumptions are very reasonable. And in my bear case is just assuming revenue grows with inflation, no growth in production at all, operating margins of 12%, which certainly for a single year, they could be lower, but throughout the cycle, 12% operating margins for them, this is extremely low. I'm giving them no credit for free cash flow for the next 2 years, and I'm only giving them a 7 times multiple. And yes, in this scenario, you would be down on your money after 5 years, but this is really an extremely pessimistic picture that I think I've painted here with these numbers. The upside bull case, I don't think this is outlandish. I'm giving them 7% growth on the top line, operating margins of 18%. Yeah, that's on the high end, but again, this is our bull case. I'm still bringing down free cash flow a bit for the next couple years, and I'm only giving them an 11 times multiple. And in this scenario, you're looking at a 40% annualized return on your money with this stock. That is a 5x over 5 years. I just think the risk reward we're being offered today for Adecoagro is excellent. It's just too cheap. It's a well-run business, a low-cost producer that is increasing production, that is trading for just, 7 times estimates for forward free cash flow, forward earnings. At the same time, they pay a nice dividend, they buy back stocks. You're getting compensated to wait here with AGRO. I understand the stock might not be a fit for everyone. This isn't a recommendation to buy it. After all, I'm just explaining why it's a fit for me, why I add it to my position here. I think while there's always risk, the risk that I'm taking on with this company is fairly uncorrelated with the risk to my other positions. I have almost no exposure to agriculture in my portfolio, and I think there's a lot more uncertainty about the future demand of certain technologies than there is about, the future demand of rice and wheat and corn, soybeans, sugar. People need to eat. AGRO is a quality producer of these goods. I should mention before we wrap up, I consider currency risk here to be relatively low. Most of their revenue is in dollars. They sell these goods in dollars. The costs are primarily in local currencies. So, if you're concerned about runaway inflation in a South American currency, the Argentinian peso losing its value against the dollar, that's actually not a significant risk, I think, to AGRO's earnings. And as far as how big of a position this is for me today, before buying a couple days ago, this was a 1% holding, and now it is a 1.2% holding. So, not a big change, but that's how it is a lot of times in investing. We're not making dramatic changes to our portfolio all the time. I have some dividends or some money come in. I'm adding a little nibble here and there. And with that, I think we'll wrap it up here. If you got value out of the video, subscribe to the channel. If you want to grab my Google Sheets template, very soon I will release a Patreon. This will be on there. I'm just waiting for Google to approve my Deep Value Hunter Google Sheets add-on before I release my Patreon. I want you to have access to this before I launch that, so hopefully it won't be too long. I've heard the approval process can take a little bit, but fingers crossed here that I'll be able to share this with you all very soon. If you agree or disagree with anything I said about the companies in this video, let me know your thoughts down below, and I hope to see you all in another video.